Hello and welcome to the second in a series of videos that looks at index investing in fixed income. Now, for those of you who don't know who I am, and I'm sure that's many of you, I'm Mark Dunne and I'm the editor of investment magazine Portfolio Institutional. Now, this particular video focuses on how investors are using ETFs in their fixed income portfolios. Indeed, research says that more and more institutional investors intend to use ETFs to navigate the bond markets. Lower costs, greater efficiency, and improved pricing transparency are all said to be drivers. What I want to do now is really get to the bottom of what's happening, and to help me, I've been joined by Justin Wheeler. Hey, Justin.
Hi, Mark. How are you?
Good, thank you. Good, thank you. And I'm sure you can do a much better job of introducing yourself there than I could. So over to you.
Thanks very much. Yes. Thanks for the time today. My name is Justin Wheeler. I've been with the BlackRock business for about 10 years now, always working within our iShares ETF franchise. And I currently lead our UK iShares asset owner sales and distribution team, particularly covering ETFs and index vehicles.
It sounds like we've got the right man. Thank God.
So.
Thank God, thank God. This could be a short conversation if not, but fine. Okay. Perhaps you could just start by explaining exactly how you were seeing institutional investors utilised fixed income ETFs, and maybe give us a flavour on how that's changed over the 10 years that you've been looking at this market.
Yeah, absolutely, Mark. I think institutional investors are certainly using fixed income ETFs in sort of new and differentiated ways in recent years. I almost think that what's more apparent is a greater understanding and acceptance of some of the core benefits that fixed income ETFs can bring to portfolios. I mean, let's not forget, fixed income ETFs and ETFs in general are inherently versatile vehicles. They are low cost, liquid, transparent, and they can really help bring improved portfolio flexibility, reduce complexities, and I think just really help streamline the overall portfolio construction process. If I think about some of the big trends that have evolved for us in the UK institutional market over recent years, I would say they evolve around four main themes. The first one would be tactical asset allocation. So ETFs certainly help investors sort of trade around market moves, macro news, implement relative value trades in a very precise and sort of granular allocation. We saw through COVID 2020 some of the volatility, the heightened volumes within fixed income ETFs. And I think it was really testament to how investors were able to de-risk and re-risk within their portfolios in a very fast, cost-efficient and precise manner. I think it was really truly valued by our clients. The second big use case is ETF liquidity sleeves. ETFs typically trade with much tighter or lower bid-ask spreads relative to their underlying bond markets, especially for those bigger, more established, larger fixed income ETFs. And that really results in lower transaction costs and lower sort of trading around these exposures. It allows investors to remain invested, but also be able to generate and raise cash at short notice. The other big piece around ETF liquidity sleeves is also around how they're a growing complement to investors around private market allocations. We know private market allocations are growing. And one of the key challenges that investors have is, what do I do with this idle cash during the capital call period? We've seen a lot of growth of ETF investors using baskets of ETFs to basically do more with that cash, yet still retain that liquidity to fund those capital calls as and when needed. The third big use case is around strategic asset allocation. Strategic asset allocation to markets such as China has proved to be very attractive, just given some of the distinct portfolio characteristics available. But accessing the market is still very challenging. It's cumbersome, it's operationally a struggle, it's very resource intensive. And we've seen a number of our big UK pension plans actually look to trade, a European domiciled ETF that trades on European exchanges, which allows for sort of real-time, in market hours access to an allocation like China bonds in your portfolios. And then the fourth big theme is around sustainable implementation. I think ESG and sustainable investing has clearly been top of mind for so many of the investors we work with. And the growing range of sustainable fixed income ETFs is really allowing those investors to take more control and express their sustainability and implement within portfolios that's aligned to their needs. So that sort of breadth of range is offering a lot of value to investors. I think the ability for investors to be able to quickly adjust fixed income portfolios is really mission critical in today's market environment. And I think having that portfolio flexibility allows for investors to better be able to achieve some of their income and yield goals, but arguably even more important, better manage diversification and risk. I mean, we saw in COVID 2020, it demonstrated that managing fixed income allocations through individual bonds can be very challenging. I think the lack of liquidity, the difficulty around transparency and pricing really led many portfolio managers and traders to use ETFs to better understand sort of rapidly evolving market conditions, to sometimes help price individual bonds, to sort of implement not only relative but also absolute value trade opportunities, and to hedge unwanted risk. I think ETFs offer that deep liquidity, that continuous price transparency, and that low cost that is not always available in those underlying bond markets. July 2020 was the 18th birthday for many of our first fixed income iShares ETFs. And it was kind of a symbolic passage into adulthood. I think we remain very optimistic about the growth of ETFs, not just from an asset growth of fixed income ETFs, not just from an asset base, but also in their ability to help institutional investors sort of achieve better outcomes and more quality within their fixed income portfolios.
Good. Thanks for that. You did mention liquidity there almost briefly. Could you expand a little bit about how institutional investors are managing liquidity in this space?
Yeah, absolutely. I mean, liquidity is a key concern. And I think, in today's world, I think there's a clear realization that liquidity is far more than a sort of nice to have. It's a clear must within portfolios. So we've seen over the past sort of, 5-10 years, ETFs become a much more common tool to manage liquidity alongside other Delta One instruments, particularly, if you think about constrained bank balance sheets and also the massive issuance of bonds over the past decade. The ETF sort of liquidity value and benefit, I think, has also grown significantly because of a few primary drivers. One, we've seen a big growth in the market overall, and also we've seen a reduction in the holding costs for ETFs. So we think about ETFs, when ETFs grow in size, there's typically more shares and ETF units available in the secondary market to be traded. And subsequently, we see higher trading volumes and tighter pricing. When we combine this with a falling TER generally across the ETF and certainly in the fixed income ETF world, it's really allowed investors to access that liquidity value and benefit at a fraction of the cost than they were historically able to do. So I think that's adding a ton of value. I think we saw during COVID, generally just a huge adoption of fixed income ETFs across the globe, primarily because of that certainty of execution and that transparency as it pertains to pricing, particularly when that underlying market had gone through challenges. So if we just think about some of the statistics, during February and March 2020, our iShares fixed income ETF volumes grew to about $17.5 billion on an average weekly basis, which was more than 2 times the sort of $7.8 billion we had seen throughout 2019. On days like March 12th, which was one of the most challenging sort of days for equity markets and certainly for credit markets in a long, long time, we saw our LQDE, our dollar investment grade corp bond ETF, trade around 1,000 times on exchange. And its US domiciled equivalent, LQD, traded about 100,000 times on exchange. And this is compared to just 37 times for some of the top bonds in the underlying index that traded on that day and during that period. So we can clearly see that there's a huge amount of sort of liquidity going through the ETF during these volatile periods. In fact, if you look again during the whole of March, LQD's underlying index, over half of the benchmark, over 50% of that benchmark, those bonds only traded between 0 or 1 in 5 times on average per day through that month. So a real significant difference. And I think ETFs are really helping fulfill some of the liquidity gaps and challenges that investors are facing in the market at the moment. These high trading volumes, I also think, have supported the notion that ETFs have allowed for sort of actionable pricing for investors at a time when the underlying markets were going through struggles. And I think as such and subsequently, fixed income ETFs have now become central to so much portfolio valuation, portfolio construction, and portfolio risk management for institutional investors. I think when you think about liquidity, to sort of summarize it, ETFs add a really important additional layer of liquidity for investors to leverage. I think ETFs are certainly helping drive a big modernization of the bond market and creating a more robust and sort of structured bond ecosystem whereby many participants can benefit.
Thank you very much for that, Justin. Finally, sustainability, whether that's called ESG, responsible investing, corporate social responsibility, it's a growing trend. So is that applicable to a fixed income ETF?
Absolutely, absolutely. I think, demand for sustainable investment solutions has grown significantly in recent years. ESG investment risks has, again, been top of mind for so many of the investors we work with. And I think sustainable indexing is commonly being used as one of the main tools to address this topic. What's challenging, though, and what remains challenging is some of the implementation around ESG, right? A lot of different investors have a lot of different needs. Many of them are at a very different place in terms of their sort of ESG journey. And the topic is pretty fast moving when you think about sort of society demands alongside regulatory impact. Some clients are looking for replicas of their non-ESG exposures, while others are going far more aggressively into sort of high ESG outcome products, such as green bonds, for example. For us, where we've really been helping clients is identify the right product and exposure to meet their sustainable goals and objectives, but then also help them think about how to implement sustainability across the whole portfolio and integrate sustainability into the portfolio construction process. In the UK, we've probably seen a few different key use cases, but some of those that really resonate for us are around using sort of fixed income ESG ETFs as a transition vehicle. So while these big corporate entities are thinking about and building out their sort of ESG and sustainable framework, which can take many years, I think ETFs and indexes are playing a vital role to get some allocation during that journey, because it allows them to sort of easily allocate into the areas they want to go to down the road once they've really structured that ESG and sustainable framework and sort of structure that they're moving towards. The second big area is probably around precision exposure. Again, just given the breadth of fixed income ESG ETFs and the growing kind of availability, it's allowing many institutional investors to achieve that sort of ESG granularity that they're sometimes looking for. And then, another good example would potentially be an area like, stepping out of cash or equitizing cash. That's a common use case for ETFs. And today, through the use of some of our ESG related products, you can still continue to do this, but embed and maintain ESG in the process. As I said earlier, I think with an ever expanding fixed income ESG ETF platform, whether it's across ESG screened, ESG sort of impact or ESG enhanced, investors are able to take more control of that ESG implementation within their portfolios. Again, for some, that might just mean sort of screening out controversial companies or businesses. For others, it might be something far more focused on a specific topic, be it climate change, net zero, low carbon transition. I think ultimately it's helping clients, again, just take more control and express their ESG views within their portfolios. From a fixed income perspective, I think from a flow angle, we've typically seen a lot of flow into sustainable fixed income ETFs in that sort of broad core sort of fixed income exposure, your sort of typical dollar, euro, sterling, investment grade corporate space. But we also, again, see a lot of interest in areas like ultra short or short duration fixed income. Think about those products and that product suite. Again, it's designed to help investors quickly equitize cash or step out of cash as they sort of search for more yield in a very kind of yield constrained environment. As they do that, having an ultra short ESG suite allows them to continue that process, be efficient with their capital, but embed and integrate ESG into the process. I think as an asset manager, it's clearly sort of vital that we develop and think deeply about how we bring ESG and sustainable solutions to our investors. We sort of expect at BlackRock that sustainable ETFs and sustainable index mutual funds are likely to grow about 5-fold to about 1.2 trillion over the next decade. And I think ETFs, particularly fixed income ETFs, alongside some indexing, are going to play a key role in that process.
Thank you very much for that, Justin. I think we've covered a lot there, and it sounds to me like ETFs in fixed income are going to be quite influential going forward. So thank you very much for joining me. Thank you. Goodbye.
Always a pleasure, Mark. Thanks a lot.